Many people talk about or are concerned about having sufficient funds to be able to have an enjoyable retirement. Unfortunately, many people do not start thinking about this until 5 or 6 years before their retirement date. Waiting until 5 or 6 years before retirement to begin retirement income planning is often too late. 5 or 6 years before your retirement generally will not give you enough time to put aside sufficient funds to have a stress-free retirement. Hello, my name is Brian Ramsey, and in this video, we will look at the financial side of retirement planning. During my working career, I have had several roles, ranging from accountant to managing director of a company to regional director in a company that operated across several countries. In this video series, I will share ideas about retirement that I have learned through personal experience and through the experience of others. The best time to begin accumulating money towards your retirement is when you begin your working career. And that has to do with the effect of compound interest over time. To demonstrate this, let us look at a simple example. In this example, we place $10,000 in an investment account that will earn a 5% rate, and we look at what it will grow to over 5, 10, 15, 20 years. Let's look at the chart that's on the table, and you will notice how the longer the money stays, the greater it accumulates to. That's the effect of compound interest, and that's the benefit of beginning your financial planning for retirement when you first start working. Your money has a longer time to grow and accumulate to provide you the funds at your retirement date. So what are the possible sources of retirement funds? One option is to place money every month into a savings account or in a credit union account. Generally, however, money placed into a personal savings account will earn a lower rate of interest than other investment options. In addition, it is too easy for you to skip a month and then skip another month. And by the time you reach to retirement, you realize that you have not accumulated sufficient funding for your retirement. Or it becomes too easy to dip into that account for whatever reason. And again, by the time you reach retirement, you find that you have not accumulated sufficient funding to give you the retirement lifestyle that you desire. Now, it's not a bad idea to place money into a savings account or a credit union account. It'll provide you with a source of easy cash during your retirement. However, it is not the best option, or it should not be the main source of funding for your retirement income. One of the main ways that you can fund your retirement income is through a company pension plan or company retirement savings plan. This has several benefits. Firstly, it will earn more than if you had placed the money into a personal savings plan. Generally, companies will match your contribution to the pension plan at least up to a certain amount, so that you have double the amount of money going into your retirement fund. Most pension contributions are tax deductible, so that you get a tax benefit. In most company pension plans or company retirement savings plans, the money is deducted directly from your salary. So there's no opportunity for you for skipping a month or dipping into that plan, thus preserving the amount of money that would be there for your retirement. Therefore, investing in a company pension plan is a good way to fund your retirement income. Some other things to note about company pension plans. Periodically in your working career, you may change companies, you may change jobs. Always find out what will happen to your pension benefits if you change jobs and what you have to do to preserve those pension benefits. Always learn what benefits you have from a previous employer. There's nothing wrong with collecting multiple pensions from different employers upon your retirement. Some people, when they reach retirement age, only then do they find out what their monthly pension will be. Periodically during your working career, you should seek to find out what your monthly pension would be based upon your contributions to date and what it's likely to be upon your retirement. The purpose of checking periodically to see what your pension benefit will be is to determine whether this is sufficient to support the retirement lifestyle that you desire. What should you do if your company pension plan will not give you sufficient funds upon retirement, or if your company does not have a company pension plan? In those situations, you should take out an individual retirement account or purchase an annuity from an insurance company. This will provide you a means of funding your retirement, and usually it gives you a tax benefit as well. Before I proceed, let me ask that if you like this video, please hit the like button and share the video. Also, if you have not already done so, please subscribe to the channel and remember to click the bell to be alerted whenever a new video is posted to the channel. What about stocks and bonds? After all, these are the assets that pension plans and insurance companies invest in to be able to pay you a pension. Stock prices, however, fluctuate, even A-listed companies. And the strength of a bond really lies in the strength of the issuer. If you want stocks and bonds to be part of your retirement portfolio, you should use the services of a certified financial planner to guide you in terms of which stocks and bonds you should be investing in, when is an appropriate time to sell, whether to hold, generally to guide you on that whole part about investing in stocks and bonds. Even with the best laid plans, life sometimes intrudes, making it difficult for you to follow the plan. You may have children that you have to put through college, or maybe an medical emergency arises, and as a result, you have to take a pension holiday. When you're able to resume investing into your retirement fund, you should do so, but you shouldn't resume putting the same amount as what you previously placed. You now have to put more. You have to increase the amount that you are now investing in that retirement fund to make up for the time period that you missed because of the emergency or putting the children through college or whatever caused you to have to stop putting money into your retirement fund. Extra money, how to deal with it. What do I mean by extra money? You may get a bonus from your employer or a tax refund. Some people form the view that they have worked hard for this and therefore they now need to go and splurge. They need to reward themselves. There's nothing wrong with rewarding yourself for the hard work that you may have put in. But the question is, do you need to spend all of the money? Or maybe you can take some of the money and place it into your retirement fund. In a sense, you would be rewarding yourself. It's just that the reward will come a bit later on. Now, what about national insurance and social security? these government operated plans do provide a pension income. Definitely when you reach retirement age, you should follow the steps to be able to begin to draw that pension. However, many people find that the money from the pension from national insurance or from social security is not sufficient to fund the lifestyle in retirement that they wanted. So, you should examine what you anticipate to get from social security and then find, if possible, additional avenues for funding that future retirement. Always remember, financial planning for retirement requires some sacrifice now for reward later in life. Financial planning for retirement is not the only thing required to have an enjoyable retirement. On this channel, we will examine some of the other things that are required for having an enjoyable retirement. Things such as friends, hobbies, travel, and much more.